Have you ever felt like you're running on a treadmill, working harder and harder, but your money just doesn't seem to go as far as it used to? That gallon of milk, that tank of gas, that dream vacation, everything costs more. We call this inflation, and we're often told it's just a natural, unavoidable part of the economy. But what if I told you there's more to the story? What if I told you that for some, inflation isn't a problem to be solved, but a tool to be used? Today, we're going to pull back the curtain and explore a controversial but crucial idea. The government needs inflation more than you do. Now that's a bold statement, so let's break it down. To understand this, we first need to talk about debt. And I'm not just talking about your credit card bill. I'm talking about national debt. Governments, just like people, borrow money. They borrow massive amounts of it to fund everything from infrastructure and defense to social programs. As of today, the national debt for many countries is sitting at astronomical levels, trillions and trillions of dollars. So, how does a government manage such a colossal pile of debt? They could raise taxes significantly, but that's politically unpopular and can slow down the economy. They could slash spending, but that's also politically difficult and can lead to public outcry. This is where inflation enters the picture as a silent third option. Think about it this way. Imagine you borrowed $100 from a friend 10 years ago. Back then, that $100 could buy a lot, maybe a full cart of groceries. Now, if you pay your friend back that same $100 today, its purchasing power has significantly decreased. Thanks to inflation, that $100 might only buy you half a cart of groceries. The numerical value is the same, but the real value has shrunk. The same principle applies to national debt, just on a much, much larger scale. Governments borrow money in today's dollars, but they pay it back with tomorrow's dollars, which are worth less due to inflation. So, if inflation is running at, say, 3% per year, the real value of the government's debt is effectively shrinking by 3% each year. It's like a hidden tax on the money you hold. The government's massive debt becomes easier to manage, not by paying it down, but by devaluing the currency it's denominated in. It's a slow, subtle way to default on their obligations without officially defaulting. This process is often called inflating away the debt. It's a powerful and tempting tool for policymakers. It allows them to continue spending without having to make the tough, unpopular decisions of either raising taxes or cutting programs. The government gets to maintain its spending levels, and the debt burden quietly becomes more manageable over time. But who pays the price for this convenience? You do, the average citizen, the saver, the retiree. If your salary doesn't increase at the same rate as inflation, your purchasing power is falling. You're getting a pay cut in real terms. If you've been diligently saving money in a bank account for your retirement or a down payment on a house, inflation is silently eroding the value of those savings. The interest you earn is often less than the rate of inflation, meaning your money is actually losing value just by sitting there. This creates a system where holding cash is penalized. It pushes people to become investors and speculators, forcing them to take on more risk just to preserve their wealth. You have to invest in assets like stocks, real estate, or other commodities that you hope will rise faster than inflation. The problem is, not everyone has the knowledge, resources, or risk tolerance to become a successful investor. This widens the gap between the wealthy, who own assets that appreciate with inflation, and the working and middle classes whose wealth is primarily in cash savings and wages that struggle to keep up. Another way governments benefit from inflation is through taxes. This is a bit more complex, but it's incredibly important. It's called bracket creep. Many tax systems are progressive, meaning the more you earn, the higher your tax rate. Now imagine you get a 5% raise to keep up with 5% inflation. In real terms, your purchasing power hasn't changed at all. You're not any wealthier, but on paper, your income is higher. This higher nominal income can push you into a higher tax bracket, meaning you end up paying a larger percentage of your income to the government, even though you aren't actually any better off. The government's tax revenue increases automatically, without them ever having to pass a new law to raise taxes. It's another stealth tax courtesy of inflation. Furthermore, capital gains taxes are also affected. Let's say you buy a stock for $100 and sell it a year later for $110. On paper, you made a $10 profit. But if inflation was 7% that year, your real gain was only $3. Yet, you'll be taxed on the full $10 nominal gain. Inflation inflates your taxable gains, and the government gets a bigger cut. So when you see it all laid out, it starts to make sense, doesn't it? Inflation isn't just some random economic phenomenon. It's a powerful policy tool. It helps governments manage their massive debts. It increases their tax revenues without having to raise tax rates explicitly. And it encourages spending and investment, which can stimulate the economy in the short term. But for the individual, for the saver, for the person on a fixed income, it's a constant headwind. It's a silent erosion of your wealth, your savings, and your hard work. It is a transfer of wealth from the hands of the public to the balance sheet of the government. This isn't about saying all inflation is bad or that government officials are sitting in a room cackling as they print more money. The reality is far more nuanced. A small, stable amount of inflation is often seen by economists as a sign of a healthy, growing economy. It encourages spending and can make it easier for wages and prices to adjust. But when inflation becomes high and unpredictable, or when it's used as a long-term solution to fiscal problems, it becomes a destructive force for ordinary people. So what can you do? The first step is understanding the game. Recognize that the money in your savings account is likely losing value over time. This knowledge empowers you to make smarter financial decisions. It means learning about different types of assets that can act as a hedge against inflation. It means paying close attention to fiscal policy and understanding how government spending and debt will impact your financial future. It means advocating for responsible fiscal management from our leaders. The narrative that inflation is just an unfortunate side effect is incomplete. For the largest debtor in the room, the government, it's a very convenient feature. And understanding that is the first step toward protecting your own financial well-being. If you found this information valuable and it made you think, please hit that like button and subscribe to the channel for more content that challenges the way you see the world. I'd love to hear your thoughts in the comments below.